Welcome back, everyone. Today, we're diving into something dangerous. No, it's not a rumor or a theory or some fringe panic. It's a slow-motion financial detonation that's already underway. It's corporate America, beginning to crack under the weight of its own debt. And the alarm bells? They're being rung by the biggest names in the financial world. Jeffrey Gundlach, the man they call the Bond King, just made a move that speaks volumes. His firm, Double Line Capital, has slashed its exposure to high-yield bonds to the lowest level in its history. Why? Because the risk isn't worth it anymore. Because what's coming could break the entire game. Let's break this down. Over the past 2 years, something subtle but deadly has been happening in the shadows of global finance. Investors, especially the smart ones, have been quietly backing away from high-yield and speculative-grade corporate debt. They're not being dramatic, they're being rational, because as Gundlach put it bluntly, investors are no longer being compensated for the risk they're taking. Let that sink in. You're lending money to shaky companies in a high-inflation, high-risk world, and getting historically low returns in exchange. Right now, spreads, or risk premiums for junk bonds are hovering around 3 percentage points. That sounds okay, until you realize the 20-year average is closer to 4.9%. And you know when spreads were this tight last time? 2007. Right before the global financial system exploded. So here's what this means. Investors today are taking just as much risk for far less reward. And history says that doesn't end well. Gundlach isn't alone. Jamie Dimon, CEO of JP Chase, the most powerful banker on Wall Street, said if he were managing a fund right now, he'd stay out of credit markets entirely. Then there's Josh Easterly from Sixth Street Partners. Same warning. These aren't YouTube doomers or Twitter speculators. These are Wall Street's elite, and they're stepping away from the fire. And yet, shockingly, investors are still rushing in. Demand for high-grade corporate bonds has been so ravenous this year, some new bond issues have seen 4 times more buyers than bonds available. It's a frenzy, a stampede. And like all stampedes, it's being driven by fear and greed. Fear of missing returns and greed for yield, even if the ground is cracking beneath their feet. But here's the part most people are missing. Beneath the surface of this euphoric buying, cracks are showing. Last month was the first time since December 2023 that more blue-chip companies were downgraded than upgraded. That's rare, and it's a clear reversal of a years-long trend. Even the big, supposedly stable corporations are showing signs of strain. Cash reserves are shrinking, even at major firms. That's never a good sign. And then, there's the Middle East. Israel's recent illegal strikes on Iranian targets, under international law, have introduced a whole new level of global instability. If this escalates, if oil prices spike, if the Strait of Hormuz is disrupted, then global inflation will reignite like gasoline on a fire. And when inflation rises, bonds fall, every time. Imagine what could happen if Hormuz is shut down, because this isn't just a regional conflict anymore. It's a domino that could hit the global credit system hard. Let's talk about why inflation is so dangerous for bonds. Bonds offer fixed payments. Inflation eats away at that fixed value. If inflation rises unexpectedly, bondholders lose big. That's why central banks, especially the Fed, have been forced to stay hawkish. Tight, restrictive, no rate cuts, no liquidity, no bailout, yet. And that is the exact environment where speculative corporate debt gets crushed. To make matters worse, the actual quality of the bond market is deteriorating. Fast. By the start of next month, $50 billion worth of corporate debt will have been kicked out of high-grade bond indexes due to downgrades. Only $8 billion has gone up into investment grade. That's a 6-1 downgrade to upgrade ratio, the worst since 2020, right in the heart of the COVID crash. Let me give you one example. Warner Brothers Discovery. After announcing a major breakup, Moody's cut their rating to junk. They just became the 5th largest fallen angel ever recorded in JP Morgan's high-grade index. And this isn't an isolated case. It's a trend. Investors are beginning to show cracks in their confidence. The riskiest slice of junk bonds, CCCC-rated debt, is now underperforming higher-rated junk. This is one of the clearest signs that default fears are creeping back into the market. Even as the broader indexes look fine on the surface, the foundation is beginning to rot. It's like watching the first tremors before an earthquake. You don't know exactly when the big one will hit, but when the pressure builds like this, you know it's coming. So what's next? Between $15 billion and $20 billion in new high-grade bonds are expected this coming week. But don't expect fireworks. Why? Because the Federal Reserve is about to speak. On June 18th, they'll release their latest policy statement and economic projections. Bloomberg economists are forecasting a hawkish hold, meaning no rate cuts and a firm stance on inflation. Then on June 17th, the May retail sales numbers drop. They're expected to show a tiny 0.1% decline, mostly from weak auto sales. And on June 16th, we'll get new activity data. Don't expect good news. Even the so-called US-China trade truce hasn't delivered any signs of a real rebound. So here's the bottom line. Wall Street's top minds, Gundlach, Dimon, Easterly, they're not screaming. They're doing something scarier. They're quietly exiting the game. They're waiting on the sidelines because the math doesn't lie. Corporate debt downgrades are outpacing upgrades. Inflation is stubborn. Geopolitical shocks are multiplying. And yet, investors keep piling in, blindfolded. This is what a pre-crash environment looks like. And when it turns, because it will, the shift will be brutal and sudden. So ask yourself, when the music stops, who's going to be left holding the bag? If you found this breakdown useful and eye-opening, don't forget to like this video, subscribe to stay ahead of the curve, share this with someone who needs to hear the truth about the financial markets. Stay sharp, stay skeptical, and stay safe. See you in the next one.